Hello everyone, it's April already. Start of the second quarter of 2022. Real estate is going through some changes right now, and we're going to look at how that is affecting the Lomita real estate market. And stick around to the end to find out how rising interest rates and inflation might change things for you. Now, home values are up a little here in Lomita, with median home values at $874,000. That's up 0.73% over the last month. It's up 1.63% over the last quarter. It's up 10.81% over the last 12 months. And it's up 21.6% over the last 2 years. And it's up a substantial 30.95% over the last 36 months. In comparison, the median home value in Los Angeles is only $798,000. In California, it's $724,000, and for the entire country, it's only $317,000. If you want to find out what your home's worth right now, go to housesinSouthBay.com and get an accurate valuation. Hello everyone, Steve Huhta here from Century 21 Union and housesinSouthBay.com, bringing you the Lomita Real Estate Market Report for April 2022. Now remember to like and subscribe, and especially leave a comment below so I know what content to make that's most helpful for you. Now, looking back in March, we only had 12 homes for sale in Lomita. 9 new homes came on the market, but 11 homes sold. Those 11 that sold range from this 2-bedroom, 2-bath, 1,750 square foot condominium that sold for $695,000 to this 2,384 square foot, 4-bedroom, 3-bath home on a 6,988 square foot lot that sold for $1,360,000. To get an idea where things are headed, we look at the health of the market with a comparison of supply versus demand. We measure that with inventory months of supply, which is only at 0.7 months supply right now. That means if no new homes came onto the market, we would sell out of homes in about 3 weeks. Now you probably already know, but we consider anything less than 6 months supply a seller's market, where prices are going up and things are selling rather fast. Now at the beginning of the video, I said I'd go over what rising interest rates and inflation mean for you. Well, it means less buying power. I know you already know that, but do you realize how much less? If you take a look at this chart, we can see that back in January, when our interest rates were around 3.25%, we could have bought a home for $1.1 million for around $4,800 a month. And today in April, with interest rates around 5%, if we had the same payments of around $4,800 a month, we could only afford a $900,000 home. And it's predicted that by the end of the year, rates may go up to 6%, which means that for that same payment, you'll only be able to afford a $800,000 home. So if you wait, you have a good chance of getting a lot less home for your money, or as you can see, paying a lot more for the same home. For that $1.1 million home, you'll be paying about $1,000 or more per month than you did in January. And if rates go up to 6%, you'll be paying almost $2,000 more for the same house. So that's what interest rates do to your payments. But I also mentioned inflation. Well, inflation has kind of the same effect on your purchasing power as rising interest rates. You get less house for your hard-earned money because your money is worth less. But this is the reason you invest in real estate. It's like other tangible assets. If we look in the past, real estate has been a hedge against inflation. As you can see throughout the last 50 years, real estate's been a good bet against inflation, gaining value well above the inflation levels. And even in economic downturns, such as the tech bubble in the 80s or the Great Recession in the 2000s, real estate has held almost even with inflation. Now, if you want to learn more about interest rates or thoughts on the real estate bubble or what you should do with rising inflation, check out one of the other videos I have to get more in-depth information. Bye for now.